Welcome to Beyond the Benchmark. I'm Ryan Kasper with LSA Portfolio Analytics, and this is your IPC short. Last week gave investors another reminder that markets are still trying to balance two competing risks at the same time: slower growth and sticky inflation. And when those two pressures start showing up together, volatility tends to follow. On the economic side, the data was mixed. Manufacturing improved modestly in March and stayed in expansion territory, which was encouraging. Services activity slipped a bit, but also remained in expansion. So, the economy is not rolling over, but the message is clear. Growth is still moving forward, just with less momentum and more pressure under the surface. That pressure is showing up most clearly in prices. Both manufacturing and services surveys pointed to rising input and output costs, and much of that is being tied back to the Middle East conflict and the ripple effects from higher energy prices. Businesses are becoming more cautious. Some are building inventories as a hedge against supply disruptions, and others are already trimming around the edges to protect margins. We also saw weaker construction spending and another drop in consumer sentiment. That matters because confidence often tells you a lot about where spending behavior could go next. Consumers appear uneasy, and that's not surprising with oil prices higher, markets more volatile, and headlines dominated by geopolitical uncertainty. From a market standpoint, U.S. equities were under pressure again last week. Large caps struggled, the Nasdaq moved into correction territory, and the S&P 500 remains under pressure as investors continue to reprice the path of growth, inflation, and interest rates. Energy and materials led, while technology and communication services lagged. Interestingly, small caps held up better, which at least helped soften some of the broader damage. Bond markets didn't offer much relief either. Treasury yields continued to move higher, especially on the longer end, as inflation concerns outweighed hopes for rate cuts. That remains one of the key themes right now. If energy-driven inflation stays elevated, the Fed may have less flexibility than markets would prefer. So what's the takeaway? At the moment, markets are not pricing in a full-scale economic breakdown. They are still behaving as if this conflict remains contained and temporary. But they are also acknowledging that higher oil prices, rising inflation expectations, and weaker confidence create a more fragile backdrop than we had just a few weeks ago. That's exactly why diversification, risk controls, and discipline matter. These are the types of environments where portfolios are tested, not just by headlines, but by how different asset classes respond when inflation and growth risks start colliding. We'll continue to watch the energy market, interest rates, and incoming economic data closely. For now, the message is simple. The economy is still expanding, but the margin for error is getting smaller. Thanks for listening to this IPC short from Beyond the Benchmark. I'm Ryan Kasper with LSA Portfolio Analytics.